Hi everyone, here's something that'll make your head spin. The same SCHD fund that millions of investors trusted for steady income just delivered its worst performance in 14 years. We're talking about a fund sitting on $68.2 billion in assets, trading around $27, that's currently being beaten by 9 out of 10 funds in its category. But before you join the exodus, let me show you why this temporary disaster might be the wealth-building setup that changes your financial future forever. Fresh off the Federal Reserve's bombshell July 30th meeting, where two governors broke ranks for the first time in over 30 years to demand rate cuts, the investment landscape is shifting underneath our feet, and SCHD sits right at the center of the storm. Right now, high-yield savings accounts are paying up to 4.66% APY, while SCHD yields just 3.82%. Seems like a no-brainer, right? Lock in that guaranteed return and forget about volatile dividend stocks. Here's what those bank marketing departments won't tell you. Those juicy rates are living on borrowed time. The Fed just held rates at 4.25% to 4.5% on July 30th, but Michelle Bowman and Christopher Waller, two voting members, actually wanted to cut rates immediately. That's the first descent in 3 decades, and it signals the dam is about to break. Fed Chair Powell admitted they would have already cut rates this year if not for tariff uncertainty. With inflation dropping from previous readings to 2.1% headline and 2.5% core in the first quarter, the writing's on the wall. Here's the mathematical reality. When the Fed cuts rates and multiple members expect at least 2 cuts before year-end, those 4.66% savings rates disappear overnight. Meanwhile, SCHD's dividend has grown at a 12.2% annual rate and increased 3.9% just in the June payment of $0.26 per share. The sector rotation setup everyone's missing. SCHD's current pain comes from being positioned in exactly the wrong sectors for 2025's first half. The fund is underweight and large value by 15% and heavily exposed to healthcare and consumer staples, sectors that got crushed while tech soared. But here's where it gets interesting. The annual reconstitution just increased exposure to energy and consumer staples, precisely the sectors institutional analysts believe are most likely to be negatively impacted by tariffs in the near term. Translation: SCHD is positioned for maximum short-term pain but potentially explosive long-term gains. Looking at sector performance rotation, utilities became 2025's top performer with 10.7% gains after being ignored for years. Financial services and consumer defensive sectors both posted gains nearly 5%. Meanwhile, Apple, which represents 6% of the broad market but minimal weight in dividend funds, became the biggest drag on major indices. When defensive sector rotate back into favor, and market history shows this rotation is inevitable, SCHD could deliver those explosive 20% to 30% moves that create generational wealth. The performance reality Wall Street won't discuss. Most investors focus only on price movements and miss the complete picture. SCHD's recent quarterly return hit 2.27%, nearly matching its benchmark index at 2.12%. Not exactly the disaster the headlines suggested. The data that shocked institutional analysts. While SCHD underperformed the S&P 500 in 2025, dividend strategies as a group suddenly outperformed the broader market for the first time in years. The Morningstar Dividend Leaders Index climbed 6.5% versus just 3% for the broad market. Wall Street analysts covering SCHD's holdings see an average price target of 29.96% with a high forecast of $35.25. That represents potential upside of over 10% from current levels around $27.20 based on the fundamentals of underlying companies. Since inception, SCHD has delivered an average annual return of 12.29%. The current yield of 3.7% comes with that 12.2% dividend growth rate, meaning your income stream grows faster than most people's salaries. What institutional money is really doing? While retail investors panic sell, institutional data reveals a different story. State Street's latest institutional investor indicators show balanced risk appetite, neither aggressive buying nor fearful selling. Instead, smart money is strategically positioning for the next market cycle. Institutional flows show investors reducing broad equity allocations but using cash reserves rather than fleeing to safety bonds. This suggests strategic repositioning rather than fear-based selling. The institutional playbook. Major investment advisory firms consistently rank SCHD among the top 5 core dividend ETFs alongside VYM, VIG, DGRO, and HDV. These funds continue to provide excellent foundations for income-oriented portfolios, according to leading institutional research. Russell Investments expects 2025 to favor institutional investors due to stabilizing interest rates and potential regulatory changes. The firm notes increased portfolio transition activity as institutions position for changing market dynamics. Your strategic options right now. First, understand your timeline. If you need money within 12 months or want immediate gratification, SCHD probably isn't your play. The current underperformance is real and could continue short term. But if you're building long-term wealth, this fund has proven itself through multiple market cycles over 14 years. Conservative income strategy, 40% SCHD, defensive anchor with growing dividends, 30% high-yield savings, lock-in current 4.44% rates while available, 30% treasury bonds, government-backed stability, balanced growth approach, 30% SCHD, steady dividend growth foundation, 35% broad market funds, that's VTI and VOO, core equity exposure, 35% growth investments, technology and innovation plays, aggressive wealth building, 20% SCHD, defensive stability anchor, 80% growth-oriented investments, maximize long-term returns, critical success factor, rebalance quarterly regardless of which strategy performs best in any given period. Alternative plays to consider. Higher current income. The Fidelity High Dividend ETF, the FDVV, delivered 96% gains over 5 years versus 59% for SCHD by mixing large-cap growth with high-yield dividend stocks. Maximum safety. Lock-in current savings rates at 4.44% APY, but remember these rates fall to 2.25% to 2.50% when the Fed cuts by year-end 2027. International diversification. Global dividend investing focuses on balancing yield with quality, ensuring dividends are supported by strong earnings, low leverage, and enduring competitive advantages. The window is closing fast. Current market dynamics create a perfect storm for SCHD's eventual outperformance. Tariff impact timeline. SCHD's reconstitution increased exposure to sector most impacted by tariffs in the next 1 year or so. But current valuations are among the most attractive levels in at least a decade. Fed policy inflection. 2 FOMC, or Federal Open Market Committee, members already want rate cuts, with Powell admitting they'd cut if not the tariff. Uncertainty. Economic data shows headline inflation at 2.1% and core at 2.5%, both moving toward the Fed's 2% target. Technical positioning. SCHD trades in a tight range around $27, about 15% above its April 2025 low of $23.87, but well below its 52-week high of $29.72. When the next market correction hits, and economic cycles guarantee it will, SCHD's defensive characteristics will shine again, just like in 2022. But by then, today's attractive entry point will be history. SCHD isn't broken. It's beautifully positioned for what comes next. The same fundamentals that created 14 years of wealth building remain intact. Quality companies with sustainable dividends, low fees, and proven management. While everyone chases yesterday's winners, contrarian investors are positioning for tomorrow's opportunities. The choice is yours. Follow the crowd or follow the smart money. Current entry point, $27.17 with a 3.82% yield and proven 12.2% dividend growth rate. Next major catalyst, September Fed meeting with expected rate cut decision. The time horizon, perfect for investors with 3+ year investment timeline. Important disclosure. This content is for educational purposes only and does not constitute investment advice. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Want more contrarian investment strategies? Subscribe for insights that help you profit while others panic. Please like, share, and subscribe. Here's to your investing success. Profitable investing.